He wore the same t-shirt to meet a president, sat cross-legged on stage like the room belonged to him, told the world he was going to save it, $1 billion at a time. By the end of this video, you'll know the exact moment he could have stopped. Guess it now. You'll be wrong. Because here's what nobody watching him back then could see. He was running 2 rooms. Room 1, the one you were shown, a vault. Millions of people's money sitting inside a company called FTX, an exchange, which just means a place where anyone could buy and sell crypto and trust their money would sit there safe until they wanted it back. Room 2, the one you weren't shown, a locked door just behind the vault. Only one person had the key. And every time he needed more, he opened it. Not once, not twice, over and over again, while telling the world your money never moved. This isn't really a story about crypto. You don't need to understand crypto to understand this. It's a story about a door, and how long one man can keep opening it before somebody finally looks behind it. He didn't start with the door. He started as the kid everyone believed in, Sam Bankman-Fried. Raised by 2 Stanford law professors, studied physics at MIT, took a trading job on Wall Street straight out of college, the kind of job most people spend a decade trying to reach. Then he quit, walked away from a safe, well-paid future to bet everything on an industry most of Wall Street still thought was a joke. Crypto. In 2017, at 25 years old, he built a trading firm called Alameda Research. 2 years later, in 2019, he built something bigger, FTX, an exchange where ordinary people anywhere in the world could buy and sell crypto coins from their phone. Here's the detail almost nobody outside his circle understood at the time. Alameda and FTX weren't really separate companies. He ran both. A small, tight circle of his closest friends, and for a time his girlfriend, ran both alongside him. FTX was the vault, the exchange millions of ordinary customers trusted with their savings. Alameda was Room 2, a private trading firm making high-risk bets. On paper, a wall was supposed to separate them. In practice, that wall had a door in it, and he held the only key. While the door kept opening quietly, he built something else, loudly, in public, a reputation. He said he didn't care about being rich, only about giving the money away to do good in the world. It was even a whole philosophy with a name, effective altruism. The idea of making as much money as possible, specifically so you can give it away where it helps the most. He testified in front of Congress about how crypto should be regulated. He poured tens of millions of dollars into political donations. His face was on magazine covers. He paid millions for a Super Bowl commercial. He put his company's name on an entire basketball arena in Miami. And through all of it, still the same wrinkled t-shirt, still the same messy hair, like proof he was different from every other billionaire who'd ever asked people to trust him. People didn't just trust him, they wanted to be like him. Nobody in that crowd knew they were trusting a man who was already spending money that wasn't his. Here's what was actually happening behind that door, in language you don't need a finance degree to follow. Alameda kept losing money on risky trades, and instead of admitting the losses, it quietly borrowed more. From FTX, from the vault, from customer deposits that were supposed to just be sitting there, untouched, waiting for people to log in and withdraw them. Billions of dollars moved from Room 1 to Room 2, quietly. Then, as the losses kept growing, not so quietly. On November 2nd, 2022, a crypto news outlet called CoinDesk published a quiet, unglamorous document that changed everything. a leaked look at Alameda's balance sheet. Buried inside it was a number that shouldn't have existed. A huge chunk of Alameda's value wasn't real, spendable money at all. It was FTT, a token FTX had invented itself out of thin air, worth a fortune on paper, worth almost nothing anywhere else, because almost nobody outside FTX actually needed one. It was the first real crack of daylight into Room 2. 4 days later, on November 6th, the head of a rival exchange called Binance announced he was selling off every bit of FTT his company held, more than $500 million worth. The price of FTT started collapsing in real time, live, in front of the entire crypto world. And the question everyone started asking, all at once, was simple. If this token is worth so little the moment someone actually tries to sell it, what else in that vault isn't really there either? Here's the uncomfortable part. It wasn't hidden that well. Auditors were paid to check FTX's books and somehow missed it. Investors who'd handed over hundreds of millions of dollars never demanded a real look behind the door. Even regulators who were supposed to be watching the industry gave him a seat at their own hearings instead of asking harder questions. Everyone assumed someone else had already checked. That's usually how a door like this stays open as long as it does. Not because it's impossible to find, but because nobody wants to be the one who goes looking first. And here's the strange part. The proof it was happening wasn't even hidden. It was written into FTX's own rules, in plain text, the whole time. You'll see exactly what it said. For 4 days, the whole industry just watched. Once people asked that question, they stopped asking politely. They started demanding their money back. All of it. All at once. In finance, this is called a bank run. And a vault that's supposed to be full can only survive that kind of test if it's actually, genuinely full. His wasn't. Within a day, FTX froze withdrawals. Customers who logged in to pull out their own money simply couldn't. He called Binance, the same company that had just tanked his token, and asked for a bailout. They tentatively agreed. Then, less than 24 hours later, they walked away. There was no more delaying it. The door didn't just crack open now. It came off completely. On November 11th, 2022, FTX filed for bankruptcy. He resigned as CEO that same day. Employees who'd believed in him found out from the headlines, same as everyone else. Customers who'd trusted him found out their balances simply weren't there. By the time the numbers were finally counted, customers alone had lost $8 billion. Investors lost close to $2 billion more. The kid who was going to save the world with other people's money had lost roughly $10 billion of it, total. $10 billion is easy to say, and almost impossible to actually picture. So picture it smaller instead. Somewhere in that number was a retiree who'd moved part of a pension into crypto because a friend told him it was safer with FTX than anywhere else. Somewhere in it was a college student who'd been saving, slowly, for years. Somewhere in it were FTX's own employees, people who worked there, believed in the mission, and watched their own savings vanish alongside everyone else's. None of them got a warning. None of them got a chance to move their money first. They found out the exact same way strangers on the internet did, all at once, from a headline. If you'd had money sitting on FTX that week, it wouldn't have mattered how careful you'd been. The door didn't check who deserved to lose. He didn't run far. On December 12th, 2022, he was arrested in the Bahamas, where FTX was based, and extradited to face charges in New York. The same t-shirt and shorts image that once made him look relatable now made him look like exactly what he was. A kid who'd been handed the keys to rooms far bigger than he should have ever been allowed to hold. His trial began in October 2023, and one by one, the people closest to him, the same small circle that had run both companies alongside him, took the stand against him instead. His former girlfriend, who had been running Alameda, the engineer who'd co-founded FTX with him, a childhood friend who'd helped build it from nothing. All three had already quietly pleaded guilty. All three now told the jury, plainly, that he knew exactly what he was doing every time customer money moved through that door. And that, written into the rules clue from earlier, finally got its answer in that courtroom. Buried in FTX's own risk policy was a line exempting Alameda from the safety checks. It hadn't been hacked in. It had been sitting there in plain sight for anyone who thought to look, almost since the beginning. On November 2nd, 2023, almost exactly a year to the week after the CoinDesk report that started it all, the jury convicted him on all 7 counts. Remember the question from the start of this video? The exact moment he could have stopped? Here it is. Long before the collapse, before the CoinDesk report, before the bank run, before any of it went public, people inside his own companies had already raised the alarm, told him directly that customer money was moving somewhere it was never supposed to go. He had the chance to close the door quietly and walk away. He didn't. He opened it wider instead. On March 28, 2024, a judge sentenced him to 25 years in prison and ordered $11 billion seized to try to repay the people he took from. Not for being brilliant, not for building something ambitious, for a door he was warned about more than once and chose to keep open anyway. He's still there. As of this year, he's serving that sentence at a federal prison in California, and he hasn't stopped fighting it. His lawyers have argued the trial itself was unfair. They've asked for a new one entirely. Both attempts have failed. The door is closed for good now. It just took the legal system over a year to make that official. Here's the part of this story almost nobody saw coming. The team appointed to clean up the wreckage of FTX has spent years hunting down and selling off everything the company still owned. Because crypto prices climbed so much higher after the collapse than anyone expected, that pile of leftover assets turned out to be worth far more. So far, the trust handling the payouts has returned over $10 billion to customers, and some are on track to receive back more than 100% of what they lost. Not because he gave it back, because the market moved in their favor after he was already gone. Somewhere, there's a version of this story where the vault stayed a vault, where the door never got built at all. But trust is a strange thing to spend. It doesn't run out all at once. It runs out the way a room empties, quietly, one withdrawal at a time, until one day, somebody finally checks behind the door, and there's nothing left there at all. He wanted to be remembered as the kid who was going to fix the world. Instead, he's remembered as the reason hundreds of thousands of ordinary people had to ask a question they never thought they'd need to ask. Is it actually still there? If a door like this could stay open for years without anyone catching it, what does that tell you about the next one? Subscribe. We're opening the next one soon.